It's the day after the MPC announced their decision to retain all economic parameters, the 25th time that decision is being taken out of 28 meetings. So you can expect that there'll be a that will form part of our conversation on this episode of Business Morning on Channels Television. Good morning, and you're welcome. I'm Ini John Mekwa. Well, yesterday, the Monetary Policy Committee meeting announced its first decision for the year, which turned out to be in contrast to monetary policy normalization approach, which major global economies are adopting at this time. The central bank governor who made the announcement said that all existing parameters with the lending rate at 11.5% will be retained, and that's what came out of the two-day meeting of the MPC. He explained that the meeting had to consider not just inflation, but also price and monetary stability approach for economic growth. So those are the parameters that have been what Nigeria has been working with for some time. Now we have Professor Akpan Ekpo, Professor of Economics and Public Policy at the University of Uyo, joining us now to tell us what he has to say with this. Good morning, Prof. Good morning. Welcome to the show.
Good morning, and thank you for having me.
Good to have you. So the CBN governor believes that inflation surge that was recorded in December is transitory. I know we've heard this word a lot. We heard it a lot last year, especially when it comes to food inflation. He believes that the supply of food with projects like the rice pyramid will taper inflation in this quarter. What do you see? Do you see a tapering of inflation in the next few months?
Well, it's hard to say, because if you can recall, we've had a decline in inflation, I think 8 times. So this is the first time that we are having a marginal increase in the inflation rate. I think if all what government policies are put in place, we might see a deceleration of inflation rate marginally over time. But the exact percentage we cannot tell. But for now, I think the inflation that we are experiencing now is a result of the expenditures during the festival season. My worry is more on the food side of inflation. I don't see that tapering off except we sort out the security issues to enable farmers to go to their farms and produce enough, because it's really a supply problem. So I can see why perhaps the MPC left the rates the way they are, or the way they were, because it's too early to adjust the rate in order to fight inflation, since out of 8 times, it's just the first time that they have made a marginal increase.
All right. So with this retaining of the rate, should Nigerians and businesses expect any change, or do we just see things the way they have always been?
Well, we should definitely, if government implements its policies aggressively, we should see a change. Don't forget that the president just approved the National Development Plan. If we begin to implement that plan, and then we begin to implement the budget for this year, there should be a change, but how fast will that change come is another matter.
And what kind of change also, Prof? What kind of change?
I'm talking about, for example, the economy is suffering from stagflation. So hopefully the sluggish growth may improve. We might grow better. And when we grow better, it will be good for all economic agents, but if we don't implement the budget the way it should be, then I think we're going to have problems. Because don't forget that as we speak, the economy is still in a stagflation phase. Unemployment is still at 3.3%. As you said, inflation rate has increased slightly, still double digit. The poverty incidence is also rising, and the misery index. So even if we see a change, it will be very, very marginal if we implement the programs in the development plan and in the budget. If we don't implement them aggressively, then we'll see further deterioration of the economy. And also don't forget that even if the economy grows, it has to grow at least double digit for a long time to have any significant dent on the macro fundamentals. So I don't really see, except we look at things at the half of the year, around June. But in the next 2-3 months, I think things will just be going, will be going up and down in terms of the system. It'll be like a roller coaster for a while.
All right, and Nigeria's economy is very import dependent, and now the U.S. Federal Reserve is expected to hike interest rates today. What spillover effects do you see?
Well, you see, don't forget that the issue of inflation is very global. It's a global problem. But in the developed countries, they have more problems. So that's why the Fed is trying to hike the interest rate. If they do that, it will affect us in the sense that most of our debts are denominated in dollars. So we'll pay more for our debts. And that's the first impact that we're going to have. And also, those countries that we import from, the price will go up, and so we pay more. And that is why we need to, as much as possible, build an economy that is not too dependent on, especially on things that we can produce domestically.
And some people have also hinted that it most likely would affect capital importation, which is not in a very good state at this time anyway.
Yeah, of course. When I say if they hike the interest rate, or whatever they produce in that country, the price will go up. So if we import capital or whatever we import, of course, we'll pay more. And it's a shame that at this point we're still having a lot of capital importation. We had thought that we need, even if we import capital, it will be for a while. We should study those equipments and see whether we can fabricate them here. But over the years, we've not done that. So definitely, all the price will go up, and we have to pay the price. I mean, we have to pay more for capital imports. And yeah, we need those capital imports to produce goods and services here. Don't forget that our manufacturing sector here is not at optimum level. As we speak, that sector contributes at least, I think, not more than 10% to GDP. So there will still be capital importation, and we are going to pay more for it. That's the irony of the hike in rates in developed countries like the United States in particular.
All right, Prof, thank you so much for sharing your thoughts with us the day after the decision of the MPC. Enjoy the rest of your day.
Thank you very much. Thank you.
So another burning issue is the proposal by the federal government to extend the petrol subsidy regime by 18 months. What impacts will this have on the Nigerian economy, on the Nigerian people, and of course on businesses? Join us for that conversation after the break. This is Business Morning on Channels Television. Welcome back. You're still watching Business Morning on Channels Television, where just yesterday, the Minister of State for Petroleum Resources, Mr. Timi Silva, announced the extension or the proposal to extend the subsidy regime by the federal government. And this, he says, is to give all stakeholders time to ensure that implementation is carried out in a manner that will ensure all necessary modalities are in place to cushion the effect of the PMS subsidy removal in line with prevailing economic realities. And of course, in response to this, we have seen the suspension of the protests that have already been scheduled by the NLC. What are the implications of this decision? We have energy expert and group chairman of International Energy Services Limited, Dr. Diron Fawibe, sharing his thoughts with us. Good to speak with you, Dr. Fawibe. Good morning.
Good morning. How are you today?
I'm fine, thank you so much. So the signing of the Petroleum Industry Act, came with a lot of applause and expectations. A lot of people were happy, saying that this will be a new dawn for the industry. Does this bring a cloud of disappointment, or is it just delayed excitement?
I would say point blank that many people will be disappointed with the latest development about the effect of subsidy removal or not removal on the PIA. And I can tell you that a lot of people, especially those who ordinarily have distrust of government, will be saying that, yes, government has come again, and they have giving an alibi or excuse, for not going full throttle for the implementation of the PIA. But this is the reality, and I guess we have to make the best of the situation in which we find ourselves as regards the PIA. Government has given the reason, for suspension, and I believe it's just a section of the law that affects the subsidy and so on. I don't expect that this will be the totality of PIA that will be suspended, and the section that deals with subsidy will have to be carefully considered by National Assembly, and amendment will be made for restoration, during the next administration, because the federal government has now said that the removal of subsidy will have to be passed on to the next administration. That's after the election of 2023. And hopefully the issue will not be as serious as we are currently having, because if we are able to get the refineries that are under rehabilitation through, and Dangote refinery comes on stream, perhaps I expect that the volume of imported fuel for which occasion the payment of subsidy will be substantially reduced. It may not completely eliminate, but certainly by the time the refineries come on stream, we'll only be importing, very low level of volume of products. And if also the security agencies are able to curtail the smuggling of petrol out of the country, we may be able to stem the tide, come 2023, before the 2023 year runs out.
Okay, interesting you brought in the issue of the refineries, because that seems to be, the hope. And good enough, Dangote has said that by the third quarter of this year, they should begin, refining, and then Nigerians should be able to access that. So, because I mean, there's no contention that everybody believes that subsidy removal is a desirable policy, but it just seems the price and the timing. So from your perspective now, you think the right time would be at least when some of the refineries in the country are functional?
Yes, that has been the heart of the problem of subsidy or deregulation, or what we call at times appropriate pricing of fuel. And this matter has been in the public domain for about 4 decades. I remember we've been talking about a shortage of fuel, for Nigerian economies since the 70s. I remember there was a Oputa panel in 1975. And I don't want to bore you viewers, with details of what has transpired between that period and now. But the fundamental issue is the supply of products to the economy. And that will have to come through the refineries. If, for example, we are producing enough, through our refineries, there will be no reason for us to be importing fuel, and the issue of subsidy will not be there. The subsidy was occasioned by importation of fuel, and a lot of businesses, businesses in quotes, will go on around importation of fuel and the payment of subsidy thereto. So until we are able to solve the problem of supply of fuel through our local facilities, then the issue of importation will still be there, and which in effect will occasion the payment of subsidy. And I believe by the end of 2023, yes, if the Dangote refinery comes on stream by third quarter, fourth quarter of this year, and the Port refinery that is undergoing rehabilitation, and I believe federal government will now have to put a lot of pressure on the contractor, working on Port refinery. I don't believe the Warri and Kaduna have started, work yet. But if the Port Harcourt refinery, which is supposed to be about 210,000 barrels per day, the 150 and the 60 combined, if we are able to get it on stream, if ever it's only about 70% capacity, then it will throw up a lot of products into the economy. And I understand, this Dangote refinery is about 650,000 barrels per day. That's the nameplate. But if it's operating, say, about 500,000 barrels per day, and we combine it with 70% of Port Harcourt refinery, if we are supplying about 600,000 barrels per day of fuel, or 650,000 barrels per day of fuel through our refineries, the amount of the volume of products we'll be importing, which will occasion subsidy, will be considerably less. So that will be the solution, because it's the issue of supply of products to the economy that has caused this problem of subsidy. And I think we have to change the narrative between the end of this year and next year, God willing.
All right, Dr. Fawibe, there's some questions that just, bog my mind when we talk about, the local production, such as, are there parameters that have been put in place to ensure that the price will actually be less when, these products are being produced or refined in the country? For instance, overhead costs. What is going to be the price of crude to Dangote, for instance? What are some of the rules or guidelines, that will be used, or template that will be used for pricing? Because we have NNLG in Nigeria, but I mean the cost or the price of gas is the same as, when they export. So is there an assurance so that we don't get there and then we have, some other things coming up when we are now having locally refined products?
Well, the pricing of locally refined products will be a total kettle of fish. And I think that the government should start to consider what will be the appropriate pricing mechanism, for products supplied locally. The basic difference is this: when we import fuel, from abroad, we will be talking about the price of the fuel at the ex-refinery or ex-supply depot or facility in foreign countries. They take Rotterdam, for example, or take New York, or wherever the products will be coming from. And you cannot prevent the refiners, in those countries from pricing their products based on the price of crude oil in the world market and the processing fee and all whatnot. And then we also have to ship the products to Nigeria. If we are refining locally, for example, the freight that is associated with imported fuel will not be there. Also, the handling expenses before the products are deposited in the various depots will not be there. The refineries here will be supplying, yes, through the distribution channel that have been put in place, and certainly there will be substantial difference in prices. Now, it doesn't mean that the price of products supplied locally will be on the same level of the regulated price that we are having now. We used to talk about the import parity of pricing of products. So we now have to look at market forces. Now, it depends on what government is going to do in terms of the supply of crude oil to the refineries. Like one of the heads of state said at one time, the local refiners will have to pay arm's length price for the crude oil being supplied. But if it is the wish of government to give them discount, so be it. That will be part of what you can pass on to Nigerian consumers. But
All right.
if Dangote, for example, is paying the price of international price, of course,
Then
he
we
will
don't
have to reflect
expect. Exactly.
the price of products,
The refined products
as a
to be lower. All right, thank
yes.
you so much, Dr. General Fawibe, Energy Expert and Group Chairman of International Energy Services Limited. Thank you so much for sharing your thoughts with us on the program today.
You're
Enjoy
welcome.
the rest of your day. Thank you, sir.
Thank you, and you too. Yes, bye-bye.
After the break, AFEX Commodities Market comes up to give us details of the market that ended in the week yesterday. You're still watching Business Morning on Channels Television. Welcome back. For the week ended 24th of January 2022, total turnover on the AFEX Commodity Exchange decreased by over 25%. Well, we have, for a change, Femi Kende, analyst structuring and origination at AFEX, joining us here, not in Abuja studio. Good
Hi,
to have you, Femi.
Hi, Chimize. Good morning. Happy to be
is
here.
my name,
Sorry.
actually.
My bad. My bad. Hi,
Okay, it's good to have you in Lagos for a change. So you want to give us how the week ended and why you have that 25% drop?
Decline. So for the week, we actually saw a significant decline in the level of activities on the exchange. In terms of the volume traded, the total number of deals executed, and the turnover on the exchange. Like you rightly said, the turnover on the exchange actually declined by 25% to close the week at about 6 billion naira, 2 billion naira worth of contracts executed. For the volume traded, we actually saw 8.2 million contracts executed, and for the number of deals executed, we actually saw 602 deals executed for the week. However, the financial benchmark actually this week experienced a little bit of an uptick in the in its value reported. For the AFEX Commodity Index, we actually saw an increase of about 0.84. To close the week at 506 index points, and we actually saw the AFEX export commodity actually return its previously reported week value. In terms of the volume traded across commodities, maize continued to account for a significant proportion of the trade, as 5 million contracts were executed this week. However, we actually saw paddy rice, soybean, sorghum, cashew, and cocoa actually being traded for the reporting week. And in terms of prices, we actually saw an uptick in soybean prices, paddy rice prices, cashew prices, and then we saw a marginal decline in maize, sorghum, and cocoa prices. So for soybean, we actually saw a significant increase of 1.18% to close the week at 104 naira per contract. And then for paddy rice, we actually saw a marginal increase of about 0.82% to close the week at 226 naira per contract. For cashew, we actually saw a significant increase of about 2.09% week on week to close the week at 497 naira per contract. However, for maize, we saw a marginal decline of about 0.15% to close the week at 239 naira per contract. Same with sorghum. Sorghum actually closed the week at 239 naira per contract with a 0.13 week on week marginal decline. And then cocoa to close the week at 1,199 naira per contract with a 0.08 marginal decline week on week.
Okay, so kindly give us an update on the performance of commodities since the beginning of the season.
Right, so the first thing I would like to say is that commodities have actually increased at a faster pace compared to the same period last year. And there might be a lot of fundamentals driving this.
When you say commodities have increased, are you talking about the prices?
Yeah, the prices, right. So the prices of a kg in the open market for maize, a kg for soybean, a kg for paddy rice, sorghum, in the open market within this time period, that is from the 1st of December to right now, we've actually seen a faster rate of increase compared to the previously reported, compared to the same period as last year.
So that's good for investors, but not very good for consumers.
Yes, sure. And there are a lot of factors influencing this. Number one would be the continuous imbalance between supply and demand, as we have not been able to produce enough to service every demand or the total demand that we have in the country or the total consumption that we have in the country. Other things that might factor into this might be the fragmented nature of the commodities market, because we know that farmers live in areas that are far away from economic hotspots, so traders actually still take advantage of it, and you see why there actually exists middlemen within the markets where they buy the commodities cheaply from farmers who really don't have access to storage, and then they'll go to economic hotspot and actually sell it at a higher price to processors. So we believe that these factors, though there are a lot of things that are happening, or a lot of policies that are being implemented by different stakeholders in the value chain, but we believe for the short to medium term, these factors will continue to exist and they will continue to influence prices upward.
And then it's about a month since the listing of the FETC. How's the security performing? I
mean, I like to say it has performed wonderfully well. Currently, the FETC is about 1,249.
And it started at how much?
So the FETC was listed in December at 1,000 naira per unit. But as at now, the FETC is about 1,246 naira per unit. Now, the reason for this would honestly be the performance of the underlying commodities. But one thing we should also note is that the FETC is a unique product in the sense that it mirrors the exchange mission to actually enable that capital transition from the capital market to the commodities market, right? And given that these underlying commodities, the prices of these underlying commodities will continue to be bullish, we know that the FETC will continue to edge upward. And the fact that the FETC is a diversified form of investment in the sense that you're not just holding a unit of maize, you're holding a unit of soybean, some unit of sorghum, and it helps hedge your risk exposure as to
So even if this commodity is not performing so well, another commodity could actually cover up for it.
Yeah.
Yeah, but I mean, now that you have said it, aren't you expecting profit-taking? Once the price goes up, profit-taking comes and then it just goes down and then we start all over again. I mean
that might be the case, but how do I put this? So we have the fund manager. We have a fund manager actually managing the FETC, right? Because it's not passively managed, or it's actively managed. So in this case,
what do you mean by that?
So what this means is that the fund manager would take decisions to the best interest of the investors or the unit holders. So what this means is if he should foresee a price decline in commodities or a specific commodities, he can actually liquidate his position there. And then invest in other things that might actually increase the value of the portfolio or the value of the total assets under management. Another thing would be if he's seeing a possibility of arbitrage, right, of which it would bring profit to the portfolio, he can actually take position in order to do this, which would be to benefit of the investor. So yeah, the product is really interesting. All
right, so let's look a bit outside Nigeria now. Yeah. The thing with Russia and Ukraine is threatening energy prices in the UK, in Europe. Does it have any impact on food prices in Nigeria?
Yes, it's scary, but it has a significant impact on food prices in Nigeria.
Significant?
Yes, so the issue with this is Nigeria currently produces about 40% of its wheat consumption. And given the fact that we are large importers of wheat and the byproducts or the end products that actually come out from this wheat, we know that the typical household will want to always consume bread. The typical household might want to consume spaghetti. The typical household might want to consume certain of these things. And then the competing or the substitute to which the household might want to trade off would it be rice, corn, and all. And those prices are not so favorable for them because they're eating to their pockets. And we know that Russia and Ukraine account for about 30% of the wheat exports. So because of this, international players or international commodity market experts are beginning to price this geopolitical crisis or instability into the prices of wheat. And as such, processors would honestly want to go into the markets and honestly buy at a higher price, which at the end of the day, there will be a lot of transfer pricing to the final consumer. So, I mean...
So the world is indeed a global village.
Yes, it is. It is.
So recently, you also launched your AFEX Commodities Outlook, and the macroeconomic factors were also part of it. So what are the outstanding factors that will shape landscape this year? So
the first thing, like we've rightly talked about in this Business Morning program, will be petroleum subsidy. Right. Given that the federal government is proposing to postpone the removal or the scrapping of the petroleum subsidy in Nigeria, the removal of that initiative actually has a significant effect on commodities prices. Because as I rightly said before, farmers live significantly away from economic hotspots, so there's a need for logistics and even the infrastructure to rightly connect farmers to the marketplace, that is the good road networks, or even the technology to do that isn't really available, right? So as a result of this, farmers or people will want to spend more on transportation because logistic providers will obviously want to charge more in order to cover their profits, in order to cover their positions, right, or cover their books, right? And if logistic providers are charging more, we know that there will be increased cost of transportation. If there's increased cost of transportation, we know that this will honestly dovetail into commodities prices. And then you go to the market and you hear people say, oh, transport have increased, they've removed fuel subsidy, or this has happened, that's why rice is at this price. It has a significant effect on commodities prices or commodities performance in the coming year, or 2022. And another important thing would be, which cannot be overemphasized, is the imbalance between production and domestic consumption. I mean, according to our outlook, production of certain grains increased marginally, but this increase is not still enough to satisfy or service the domestic consumption demand for these commodities. And given that processors do not have access to FX in order to import these commodities, we know that this will continue to feed into higher commodities prices, higher food inflation, and the rest. So there are a lot of other factors, but these are the key factors we know that would affect the
landscape this year.
Yeah.
So talking to your partners now, how important is it for them to take position, talking about domestic markets now, to take position, and what position should they be looking at taking at this time?
So my advice to everybody, right, would be get exposure to the commodity space, right? You don't necessarily have to go to the physical market yourself. You could actually do it through AFEX, because AFEX has provided the infrastructure to streamline this for you. And the thing is, we've looked at the data, right? We've cross-referenced inflation to the AFEX Commodities Index performance, and we've seen that consistently, on an average, for a 4-year average, the AFEX Commodity Index has reported 23% above the inflation. So what this means is that, irregardless of capital erosion that will continue to happen in the country, I'm sure of a superior grain that will cover my capital loss and actually give me something in return.
Are you telling me you have a hedge there?
I mean, it's a superior hedge in this case in the domestic market. And then also looking at inflation to the currency or the value of the Nigerian currency in the international market, we've also observed that for every devaluation or depreciation of the naira, there's a 0.6% increase in the price of, there's a 6% increase in the price of, or the value of the AFEX Commodities Index.
6% increase in the value
of the AFEX Commodities Index.
That's a lot.
That's a lot. So it's like, if you want to also
have you cross-checked that?
Trust me, it's a data I've had to look, and I'm like, this is scary, but this is the case. This is what we have, right? So if I'm an investor looking to hedge against foreign exchange exposure, or hedge against inflation or capital erosion, I would advise, or I would honestly want to plug into the AFEX commodities market.
Not because you're coming from AFEX.
Not because I'm coming from AFEX.
All right, thank you so much, Femi Kehinde, for coming to share your thoughts with us physically this time, not from Abuja. Analyst structuring and origination at AFEX. Enjoy the rest of your day.
You too.
So let's move over to the markets now. Will Ibong is standing by to give us, I think yesterday we were marginally up. I hope this has come to stay.
Yes.
Yeah, well, that signaled the conversation, the end of this conversation with AFEX. Thank you so much from the back end now. So back to Will giving us details of the marginal uptick that we had in the market yesterday.
Yes, Sini, good morning. Now, we saw that the local bourse yesterday moved to positive territory in yesterday's session. Thankfully, 0.02% uptick there. But although it was marginal, we're hoping that today's session will prove to be better performance. Now, 45,939.51 points. That's the point, that's the basis point where the all-share index is at the moment. Now, precisely, the investors' interest in EcoBank Transnational Incorporation supported the market performance amid the sell-offs we saw in Zenith Bank and other Tier 1 banks. Although UBA was up yesterday, now consequently, we saw that the year-to-date gain has now moved up to 7.6%. We are hoping that this trend continues upward, despite the fact that the CBN decided to retain all policy parameters yesterday. I hope that that's not going to affect the market performance, because that's what we've been having. That's the existing parameters. And we see that total volume of transactions fell in yesterday's trading session. Total for 7.69 million units was traded in yesterday's session, valued at 3.58 billion naira, and it was exchanged in over 4,200 deals. Now, GTCO was the most traded stock by volume, and Seplat still remained the most traded stock by value yesterday. Now, we move to the sectors. The banking, consumer, oil and gas were in the green. Industrial and insurance were in the red yesterday. Move quickly. There was no price action in the NASD unlisted market yesterday, despite now there was no rebound there, despite the fact that they closed negative on Monday. We're hoping that we'll see a positive uptick in today's session. Now, for the fixed income space, we see that the bonds closed yesterday bullish, despite the fact that it was quite calm, and we're hoping that that would improve, or there'll be a change today. NTB, minimal activity in that space as well. We are awaiting the primary market auction, which is going to take place today, and maturity, which is going to be rolled over tomorrow. We have Choma on the line to tell us what's really going on there. Good morning, Choma.
Good morning. Thank you for having me.
It's good to have you, Choma. Choma, now, the primary market auction is going to happen today with about 129 billion offered by the DMO. What should we expect from investors, saying that the CBN Monetary Policy Committee decided to hold rates again?
It's going to basically, we'll see a lot of interest in that space. 129 billion is offered, and it's basically a recapping across street tenors with the 1 year, having the most volumes of 123 billion. We think that we're going to see a lot of interest in that space. We have over 605 billion coming in liquidity, that's bond maturity and coupon. And then we also have FAC coming. So the system is basically up over 300 billion plus liquidity we have coming into the system tomorrow. So we're going to see a lot of liquidity chasing this auction. We expect a minimal migration in rates, and then we expect that the DMO, seeing that there's a lot of interest, they tap more than they are offering today at the auction.
Chima, we know that the CBN retained the rates. We're just going to talk about that a little bit. It might seem that is the status quo, but are there concerns, like underneath the surface, are there concerns bubbling underneath the surface of the fact that we have existing lending rates at 11.5 and all CRL at about $20.7? What do we expect? Are there going to be future concerns, especially with front-loading the borrowings?
There's some pressure. If you listen to the central bank governor, there's some pressure for them to tweak the rates at 11.5, upward pressure because of inflation. We saw inflation tick up a little by 23 basis points to 16.63. But what he has said is that the change in global interest rates trending upwards will not affect the economy. And I don't think we should be in a hurry to start tweaking rates. This is the way approach to see what the economy is going to do in the next 6 weeks. I think we should also, settle down and understand. He alluded inflation increase to December spending because of the festivity season. So, yes, I know he's under a lot of pressure to keep the interest rate, the benchmark interest rate, but we'll wait and see, because really fixed income is trading at, for the short end of the curve, trading at an average of 5%. And the bonds, we saw moderation on that space because of the liquidity within the system, where the long end of the curve is at 12.9. So, we just have to wait it out and see what's going to happen at the next MPC.
Thank you so much, Choma Udu, fixed income dealer at GT Bank. Thank you so much again for coming on the show. So, Ini, that's what we have for the markets, and we are hoping that today's outcome will be a better one for the markets. Definitely for the equities as well, because I don't want a 0.02% uptick in the market anymore.
I bet you if you have a 0.02%, you should be happy that no, mine not 0.02. All right, thank you so much, Will. Well, now we'll take another quick break. When we come back, we'll do an opening call to London. Do stay with us. You're welcome back. Well, the issue with energy prices has been a source of concern for the UK for months now, especially in the face of the weather and now the threat of cutting gas supply following the Russia-Ukraine incursion. Now the International Monetary Fund is asking the UK to consider well-targeted action. We wonder what that means, but we always have Juliana joining us now to tell us what it means. Hello, Juliana. Good morning.
Good morning, Ini.
So, of course, we've been talking about the issue with energy prices for a while. What's the development that has attracted these comments from the International Monetary Fund?
Well, yes, Geeta Gopinath, who is the International Monetary Fund's first deputy director, she has been giving an interview to the BBC to coincide with the IMF's monetary outlook. Global growth has been downgraded, not just for the world's two largest economies, the US and China, but also for the UK. It's been downgraded to grow from about 5.1 to about 4.7% this year, still the fastest in the G7 industrialized nations, but there are sticking points. Most notably, of course, was the emergence of Omicron, and even though we know it's not as deadly, people are still having to self-isolate, and the economy has been affected by that. But, as you said, the IMF are showing concern about what the potential of a Russian invasion of Ukraine could mean, and we know that Russia's supply of gas to Europe will inevitably affect consumers here in the UK. As you said, the gas supply issue and surging bills has been a huge point of concern. This is one of the reasons why inflation is currently at about 5.4%. It is likely to rise when the regulator in the next 2 weeks lifts that energy price cap from about £1,200 to over £2,000, adding an extra £50 at the end of the month to people's bills. Now, Geeta Gopinath has been advising the British government to intervene and to get involved, and that's exactly what the government have been mulling over the past couple of months. We're expecting an announcement from the Treasury any time soon. Potentially, what has been suggested is that the £12.5 billion that will be raised by lifting the national insurance tax in April could be offset. That would, of course, be very controversial because we know, even aside from coronavirus, the NHS is pretty much on the brink at the moment, and that £12.5 billion is desperately needed. But is the Treasury willing to sacrifice that rise so that people will be able to survive, particularly at a time when the cost of living in the UK is at its highest in 30 years?
A question that is hanging. Well, not very good one again, as manufacturers are planning the biggest hike since 1977, and this will help them face the intense costs and price pressures. Not very good times over there, Juliana.
You said it, Inni, not me. And I think the vast majority of the people in this country agree with you. This data about manufacturing costs and how they're going to offset some of these surging prices to consumers has been delivered by the CBI Industrial Trade Survey. That's been going since the 50s. They speak to about 240 of the most successful manufacturing firms across the country, and they're all saying the same thing. They've had to increase prices to their highest in about 30 years. And this is because of the supply chain issues. This is because of soaring inflation. This is because of high energy prices, which means higher bills. And it's just too difficult for them to take the pain of that on their own. So they have offloaded some of the burden. This is creeping back on customers, which is why I believe when we had a look earlier this week at the composite PMI data for January, it is starting to creep down because people are starting not to spend because they can see what the bill is likely to be at the end of the month.
Well, we'll certainly be looking closely to the skies for silver linings in the midst of this. Oh, Juliana. Well, thank you so much. We'll talk to you at 1:30 during Business Incorporated.
Thanks, Anil.
So let's move to the crypto space now. And Ladi, is the market, do we have a mixture of red and green?
Well, Ini, there is some kind of silver lining. I hear you were looking for silver lining there. But there is one. There's been a bounce from, the sell-offs from Friday. We see Bitcoin still trying to stay, keep head above water. The market cap now, it's $1.69 trillion. Up about 3.72%. Volume traded in the total crypto space, $87.64 billion. This morning is down 30.77%. And we see Bitcoin dominance there inching up at 42.02%. Price of Bitcoin, 37,000. We see Bitcoin there has to stay above 38,000 to start, another uptrend at this point. Is struggling to get above that. Is up 3.60%. Volume traded $27.28 billion. We see Ethereum, they're also struggling to stay above the 2,500 range. It's up 3.13%. Volume traded $16.06 billion. Let's bring in Gilbert, your partner now. Hello, Gilbert.
Yeah, good morning, Mr. Rabi.
Good morning, Gilbert. So all eyes are on the Fed today for a decision. What do you think happens to the crypto space if they actually tighten rates?
Okay, these are quite sensitive period and key periods in the financial markets in generally. It is no news we are in a financial reset, which is more of a change from the traditional legacy market to the cryptocurrency market. The entire fiat market on its own, which is a quadrillion market, is hit by high inflation and a bad economy. So the dollar, which is to fiat currency, what Bitcoin is to cryptocurrency, is trying to gain back its integrity because it has been hit by high inflation, bad economy. So they are trying to gain back their integrity by tightening liquidity and making other fiat currencies as well look bad. So what is happening is that there have been major adoption of Bitcoin from institutions big institutions from Wall Street who kind of treat Bitcoin as a speculative asset. So the interest rates and the bullish structure as well on the dollar makes these guys who enter and exit trade based on market structure panic and sell their Bitcoin. So probably I think this is, it means things are not going to get better anytime soon. But what is happening is just that Bitcoin is just an incidental victim of what is happening over there. But this is not going to be for a very, very long time. It doesn't matter how people come into the adoption of Bitcoin. We just need to take note of how they come in, whether they are institutions, individuals, or governments. They will always come in, they will always face, we will always face their reaction to how they adopt Bitcoin at first. It is sensitive, we need to take note of it. But this is not going to last for a very long time. We are going to see a bullish Bitcoin over a long period of time.
Yeah, but how long does Bitcoin stay below 40K?
I think we are going to stay here for a while until people discover that there are millions of households that can no longer pay the new interest rates, until people also discover that you just can't trust the government. You have never trusted them long before now, so why trust them right now? We just need time. People will discover that you just can't trust the new policies and whatever interest rates the Feds are giving.
All right, but the Fed and the government have our interests at heart, Gilbert. Anyway, they keep protecting us. Gilbert, let's look at investor sentiment. Now, it's still extreme fear. Where do you see this balance tipping?
Okay, what is happening in the market isn't new. We just need to understand how Bitcoin reacts. Last year we have over 6 different drawdowns of over 20%. In 2018, we also had a drawdown of over 50%. We just need to understand that this is the price behavior of Bitcoin, and yet it is the best performing asset in over a decade.
All right. Anyway, let's see what happens with the Fed decision today. It could be a dump or a pump. We'll be watching that. Thank you so much, Gilbert.
All right. Thank you, Mr. Ladi.
All right, so looking at the top of the market cap, you see it's all green there with Solana there being the biggest gainer this morning, up 6% at $94.51. And we see XRP there still on that downward trend at 62 cents, but it's up 4.87% this morning. Looking at the top 5 gainers there, we see Waves there leading. That count is up 30%. We're seeing double-digit gains. It shows that traders are getting back in the game at this point, but it could be a dead cat bounce. We'll be watching out for that. HNT there, $26.47, up about 16%. So, all eyes on the Fed today. Let's see what happens. Maybe there might be a massive dump today. Who knows?
I kind of like some of the phrases that Gilbert used. He said we are in a financial reset.
Financial reset.
There are always words to use to capture.
Exactly. So this is the one word for
yes, we are in a financial reset.
Exactly.
Well, thank you so much, Ladi. And that's where we draw the curtain on the program today. Thank you so much for being a part of it. But do remember to join us at 1:30. Business Incorporated will have more updates for you from the world of business. I'm Ini John McQuarrie. Let's do this again tomorrow.